So what is a passive real estate investment? Is passive even possible in real estate? That's what we're going to dive into right now. Okay, so what is a passive real estate investment? How can you actually get into real estate without taking all your time and attention? Because there's no doubt there are active real estate investments and there's passive ones. What's the difference and how do you become more passive? Let's dive in. All right, so I'm going to talk about these passive potential options. I will just say this. Nothing is 100% passive where you can just set your money and forget it, never think about it again. That just does not work in the real world, okay? The whole set and forget it thing is how people lose money. That's even how you lose money in the stock market and places like that. Now, there are ways to do it very passively where you could take very little time and attention out. But just understand this, in anything with real estate investing, depending on what kind of investing you're doing, I'll tell you there's always gonna be an element of management that's involved. Now, I'll address active real estate investing because I'm not gonna talk about those in detail, but just kind of show you the difference. Active real estate investments, these are things like where you go and you buy a rental and then you manage that rental. You're the property manager. You're the ones dealing with the tenants, the toilets, and the trash. That is active. That's actually working for your money. Now, it might be easier than doing a job. You could make more money doing that than a job and work less hours, but you're still working for it. You know, also there's people that are real estate flippers where they buy a house for cheap because it's a piece of crap little turd thing on the street there. They buy it, they renovate it, they make it look all pretty, and then they sell it for a higher price. Real estate flippers, right? That's a very active thing. Even if you're not the one hammering the nails in and doing all that kind of stuff and painting walls, still you're having to be at least the general contractor making sure that everything gets done. And so that is also very active. Now, if you're also doing things like wholesaling, there's wholesale businesses, which are very popular. You can make millions and millions of dollars being a wholesaler where you literally could be the middle person between the buyer and the seller. And yes, you make lots of money there, but once again, very active. Now, you could have a business where you try to get more people to replace you and do the work for you, but you usually have to build up to a certain point before you can start hiring out to do that kind of stuff. Because that usually means in the early days, you're doing it all. But even then, and you want to talk with like the people that are like the most passive. Like I was on the Ryan Pineda show recently, and even as we're talking, he still was saying, yeah, I still have to manage my businesses. It's not like I just, I have a business, everybody does the work for me and I never have to look at it again. He still manages it. He's still actively involved. He's just not working in the business all the time. So there's different varying levels of active real estate investing. Now let's go to the passive side. Now I'm going to start with the one that's probably the least passive and go to the ones that are more passive than this. The least passive, that's still passive, but it might be, I call it semi-passive, would be a turnkey real estate rental. Now turnkey means that it's almost like we say, you stick the key in, you turn it, it runs, right? So turnkey rentals are different than buying your typical property in your backyard. Here you can buy properties anywhere in the country, anywhere you want. You have somebody who has a connection in that specific market. They also will help you get the financing. They'll also be the ones that helps you get the property manager in place if it's not them. And then of course, they're the ones that find the renters and do all the work while you collect the checks. Yes, they charge you property management fees, but still you're able to, ideally, if you got the numbers all known up front, which you should have done up front when you get a turnkey rental before you buy it, well then you'll be able to know, I can afford the actual payment for the property manager and I can still profit money too. Now there still could be things like vacancies, there could be maintenance and whatnot. But again, the property manager more deals with that. You just have to be aware that you might have to come out of pocket sometimes, or they might have to pull from the rent to be able to pay for some of those things. So your cash flow can vary from month to month. But I'll tell you, I mean, it's way better than what I used to do. Because I used to be the one that had the rental and then try to rent it out myself, try to do all the lease agreements and make sure you're screening the tenants and whoever might be the potential one. Then you have to like make sure that they actually pay you and all this other kind of stuff. It was hard, right? I remember trying to collect rent checks. It was not fun. However, when I have a property manager doing that for me and a turnkey company that helps me, one, find the property in those areas, wherever those areas are. Give you an example, I remember the very first one I bought was in Memphis, Tennessee. And in Memphis, Tennessee there, like they said, here's the properties around the country. And there was one in Memphis. I said, well, that one looks good. Let's get that. So my wife and I decided to buy that rental. Now, we of course did the financing, did the mortgage paperwork and all that kind of stuff. That was the hardest work we had to put in. But then after it got closed and everything was done, the property manager's been dealing more with the actual tenants and everything. Honestly, I don't even know the name of the tenant. But I love the fact that they're the ones that are renewing the leases. They're even the ones that suggest raising the rent, which I would never have the courage to do myself. They're also the ones that are dealing with the different issues if there has to be something fixed. So a lot of times they'll say if it's a higher expense, they might say, hey, we got to replace this coil in this oven. Are you cool with that? It's $200. Sure. done, and they go ahead and do it. Now, if it's something super small, like 50 bucks, I don't worry about it, or cleaning or something like that, touch up on paint. They'll even ask me, should we touch up the walls? It's been 3 or 4 years. Great, let's do that. Clean the carpets. Great. And then they raise the rent, again, help pay for that, right? So it's nice. I don't have to be hands-on with that. So that's one way you could do it. But again, it's semi-passive because you still are managing the property manager. You still might be involved, but it's not like you're dealing with it on a weekly basis. It might be maybe once a month for minutes, that kind of thing. It's really just much more passive than almost anything I've done in real estate, other than these other next ones. Okay, the next one's private lending. Now this one, it has a good element of control, but also there could be some risk depending, but you can actually control your risk much better. Lending means you're lending your money to the real estate investor. So you're not the one dealing with the properties. They say, hey, I've got a specific property. Here's what I need from you, for the loan. They're basically borrow money from you like you're the bank. Here's what I need from you for money. Here's what it's worth after it's renovated or done or whatever the situation might be. Here's the value of it. Ideally, you want that value to be maybe around no more than like 60, 65, 70% at most. When somebody sends me, hey, this is about 80%, there's 20% equity if you put your money in. To me, that seems a little bit tight, especially if there's debate about what the value actually is when they try to sell it. So I like to make sure there's plenty of equity in that property. Now, just like the bank, just like when a bank has your mortgage, if you don't pay the bank, guess what? They take your property away from you. Well, now you're the bank. So if they don't pay you, the investor doesn't pay you, guess what? You can take that property as your asset, especially at least if you design it the right way. If you have it where you're like first position or first trust deed, that kind of thing. If you do that, then you actually have more security. And so yeah, you're like the bank. They have to pay you back. And usually they'll pay you back sometimes in a matter of months, could be a couple years, depends on the project. But they'll pay you at agreed upon interest rate. Hands off completely. The hardest part, of course, is again, finding that relationship. Make sure you see the deal. You might spend a few minutes or so doing that due diligence on it, but if it looks good, and especially if you've trusted them, maybe you've done deals with them in the past, you can move forward. So that's the thing. It's again, not fully 100% passive, but that gets to be a little bit more hands-off than even a rental. The second one is a syndication. Now, syndication, same thing. It's much like they say, like in the real estate world, often you're betting on the jockey, not the horse. I like to bet on both. I like to know that the jockey, who's the operator, like say that a syndication is where you pool your money with other investors to buy a big project. It could be an apartment building. It could be self-storage units. It could be a car wash business. It could be oil and gas. It could be all kinds of things, right? I mean, it could be even commercial buildings or industrial buildings and things like that, where you pool your money with other investors, you become partners, usually equity partners in this case, and then as co-owners, you go and you help finance this deal. Now, you are not doing anything with it. All the headaches and all the stuff they deal with, it's all them. It's all based on the investment operator that you're putting your money with. The thing you have to do up front is, of course, because you're betting on the jockey as well, make sure you understand who they are. Understand how good are they? What's their track record? What's happened in the past when they've had bad deals? How did that turn out? What did they learn from it? So you got to do some due diligence up front. But once you find that and you do due diligence on the property too, make sure that at least it seems legit, then of course you can put your money with it. Hands off, you don't do anything at all. Of course, if anything goes wrong, yeah, it's possible you guys might have to, try to foreclose and claim on the property together. There could be some hassle there, but if everything goes well, really there's no management at all. And then the last one. The last one is one of my favorites, which is a partnership. Now, a partnership could be debatable. It could be more active than a syndication, depending on how the partnership's set up. But I'm in a partnership, for example, where I'm a 70% partner because I finance it, while the 30% partner is doing all the work. I literally am watching what's happening on the back end on a dashboard, right? I'm watching on the screen to see what they're doing as they're buying and selling and doing different stuff with the real estate. And the great thing is, of course, I'm just the one financing it. So understand, if you want to be more passive, it does require money. If you don't have money, you're going to be the one that's active investor. But if you want to be passive, it's using your cash to do the work while they're doing the work with your cash, if that makes sense. So I get my money to work for me that way, so I have to work for that money. And so partnerships can be a great way to do it. I mentioned oil and gas. Sometimes you go in as oil and gas partners. You get sometimes the tax benefits from that, as well as the profits and cash flow and so forth. It can be a great option for you, especially if you're trying to become a passive investor and create real passive income in real estate. All right, if you want to dig more into these passive investments, be sure to subscribe to our channel and check out this video below.